Welcome to yet another episode of DNV Market Views, our videocast where we discuss the latest market developments. Conversely to the last episode when we allowed ourselves to travel well into the future, today we focus on the current drivers shaping the business. And oh boy, do they drive this industry well. Arguably, we haven't seen such cash accumulation for a long time. Pretty much all shipping segments, whether you look at the volume markets or the niche ones, earnings are well above their 10-year averages. At the time of this recording, the Clark-C index persistently sits at some $25,000 a day, which is around 40% above the long-term average. It is a rare phenomenon that begs the question of why we are experiencing such prosperity. Bearing in mind the economic downturn, one could conclude that, the seaborne transportation should also come under pressure. Yet, things are quite the opposite. Earnings are strong, sometimes unbelievably strong, which drives the residual value of the existing assets as well as the new building prices to their historically high levels. In fact, if you look at the latter, in nominal terms, new ships have never been more expensive than they are today. Inflation adjusted, we may still not be at all-time high levels, but certainly we are not far from them. This is why we will focus on trade as a source of demand for ships and examine what actually creates such a favorable situation. Is there so much more cargo to carry, or perhaps, spoiler alert, the trade patterns have changed? We will try to answer whether the current high earnings environment is sustainable in the long run. And finally, we will take a stab at the new building markets and try to answer one of the most pressing questions. Will new building prices continue to grow, or will they soon start to come off their steep upward trend? I am pleased to introduce my guest, Dr. Adam Kent, the Managing Director of Maritime Strategies International, also known as MSI. Adam has spent more than 2 decades examining shipping markets and the seaborne trade, and today we have a unique chance to listen to his observations and conclusions. I hope you will enjoy our conversation. My name is Jakub Walenkiewicz, and you're watching DNV Market Views. Adam, it's absolutely fantastic to have you on our show. Thank you for coming over.
No, thank you. Thank you for the invite.
Yeah, I know you've been quite busy recently, so I know that it's not easy to catch you, but we really appreciate that.
Yeah, no, I'm in the UK for a couple of weeks, so you caught me.
Yeah, I got you, right? Okay. Today's session, we're going to talk all about the trades and inefficiency of trades or efficiencies, whichever way you would like to tackle it. But I think it's a bit of a sort of interesting times we have these days where disruptions, which we actually touched upon those disruptions already in our previous episodes, but those seem to be, I would say, skewing a picture of what is happening with shipping. And in a way, we know that shipping is swamped with money at the moment. This makes a huge amount of profits. And pretty much if you look across all the ship types, they are way above 10-year average earnings. But is it all true? Is it really because the economy is booming? We know it's not. It's actually quite the opposite. Is it really that much trade growth, or seaborne trade growth, that would explain why ships are making so much money? Or perhaps is something what I personally call a miles-driven markets? What's your take on it?
Yeah, I think it's a good point, very good point, and I think it's a combination of all the above. I think we have seen some relatively strong cargo growth across all sectors of shipping over the last couple of years, and we're looking at cargo growth that is above the sort of averages for the last 10 years. So the cargo growth story is there primarily across all of shipping. I think you've also sort of touched on where I think the sort of froth in the market is coming from, and that is the sort of inefficiencies and the ton-mile impact. And I think if you look back, there has been a number of instances, probably over the last 5 years, where we've seen this ton-mile impact start to crank up. And you can sort of look back to the sort of Trump tariffs in 2019. You roll the clock forward, we had COVID, That brought its own inefficiencies and increased ton miles. We had the Russian invasion of Ukraine. We've more recently had the instances in and around both the Panama and the Suez Canal, which has sort of extended those ton miles to levels that we wouldn't have seen back in 2015 and 16. And I think it's an important point to make is the last 5 years, I think we've seen more of these disruptions, more dislocations within the market than we have done across at least the duration of this century. So I think if we start sort of untangling what's actually going on, it's becoming a lot more difficult from a pure supply-demand fundamentals to work out where the market is. And there you start layering on what's happening for ton miles, the extra distances that vessels are having to carry cargoes, the longer backhaul routes potentially in ballast, and then also the inefficiencies. And we've of course seen those even last week with what was going on in and around the US port strikes on the East Coast, and everyone was sort of getting worried about what was going to happen there if that went on for more than the 3 days that it actually did. So I think from a demand side perspective, if we look forward, which what we typically do at MSI, we're a forecasting consultancy. We're perhaps seeing sort of on the demand side for something like the oil tanker market around 2% growth this year in our forecast, whereas ton mile increase year on year is probably nearer 5 or 6%. So you're getting a huge boost to that sort of the fundamentals through the ton mile impact.
Yeah, because I think people often forget that we like tons just as much as we like miles in shipping, right? Because that basically tells you what's the productivity of the fleet. And if you look across where you mentioned 2% for crude, I mean, those are sort of the numbers which are okay numbers, but it's nothing to write home about, to be honest. But when you start looking into 5 or 6% increase in the ton mile effect, and all of a sudden it's like, hold on a second, that's going to keep those vessels well busy throughout the year, which means the demand for fleet is going to be much higher. Where is your take on that, the dry bulk, for instance, and containers and in?
Yeah, I mean the dry bulk market again. We're seeing some interesting developments there. I mean, if we focus in on something like the coal trades, and we look at ton miles explicitly, now we know that a lot of the Western economies are trying to move away from coal as a primary energy source. And if you look at sort of coal imports into Europe this year, and we expect over the next couple of years to expect them to fall off year on year. However, we've got places like Colombia, South Africa that are coal exporters that would have traditionally fed that Atlantic market. Also the US. A lot of people forget that the US still is quite a large exporter of coal. So that coal is no longer going to the Atlantic basin, no longer going to Europe, but there are customers for that coal in the east. So we're seeing a lot more of that coal travelling from Colombia to Asia, from South Africa to Asia, which again is helping fuel those ton miles. So from an aggregated demand side perspective on the dry side this year, we think it would be around sort of 2.4% this year, year on year versus last year, around 2% again next year. I think the one of the interesting developments on the dry side is that we're relatively positive for the next sort of 3 or 4 years. Next couple of years, iron ore, coal will help with the growth story. I think as we sort of move towards the back end of the decade, it's going to be more grains and minor bulks that are sort of helping continue the growth within the dry sector. Now, minor bulks by their nature tend to move on shorter distances. So we could see some of the unravelling of the ton miles that we've currently seen due to the events that I've already noted unwind when we see a lot more minor bulks moving shorter distances, moving intra-regionally rather than the sort of across basins, across the Pacific, across the Atlantic, etc. So at the minute there's a ton mile story that can unwind due to cargoes alongside, and we've not discussed unwinding of other events at the sort of back end of this decade.
Okay. So, I mean, you mentioned coal now, so even though we may say that probably somewhere we are in this peak coal scenario, but it doesn't necessarily mean all that bad news for ships, because if you start extending current distances, especially if you start migrating from Atlantic to Pacific Basin, for places like Colombia and the US, I mean, inevitably you're still going to have quite a good support on earnings. Maybe not never ending, but it's going to keep it going for a while.
And you can never rule out geopolitical events. I mean, we've seen that, especially with coal over, the last few years, where China banned the import of Australian coal. That Australian coal had to go somewhere. It was going longer ton miles to places like India, even to Europe. So, geopolitical events, they seem to be coming thick and fast at the minute. And typically, there are a few instances where this isn't the case, but typically they're good for shipping, i.e. they extend ton miles, they increase inefficiencies, and tighten the supply-demand balances and push up earnings. Yeah.
And that's probably the best moment to ask you another thing, is then when we look at the Ukraine and we're no longer allowed to call it a shadow fleet, right? There's some legitimate vessels in the fleet, but it's called parallel fleet now, where arguably up to 20% of tankers sort of are on that serving that trade. Do you believe that that's something that is more permanent in, it's regardless whichever way the war goes on and how this is hopefully being resolved sooner rather than better? But do you think actually we already see a well-established new trading partners and thus indeed patterns that are there more to stay? Or do you think we'll come back to the status quo?
No, I think certainly if we sort of focus on sort of Russia, Ukraine, I think the trading routes that have now been established are there to stay. I don't see anyone reverting back to the status quo as it was pre the Russian invasion of Ukraine. If you look at places like India have become a very dominant supplier of refined products to Europe. And at the same time, of course, you're seeing a lot more crude trade going from Russia to India. I think the refineries obviously take a while to get accustomed to the grades. And I think that those networks are now established. I don't see people like NOCs or reinvesting money in Russia, because I just think there's the geopolitical risk of what could happen in the future. So I think we've seen a lot of large multinationals pull out of Russia. I think it's probably, we're obviously hearing more things like friendly shoring, near shoring. People want to sort of be able to rely on their supply chains, whether that be oil, whether that be manufactured goods, or whether that be other commodities. So I think the new trade patterns are here to stay, which certainly from a Russia perspective, perhaps not so much from what we're seeing currently in the Red Sea. And, we all hope that we see some solution to events in the Red Sea. I think once we start seeing the Suez Canal reopen fully, and it's important to say that there are still a lot of ships that are going through, certainly on the tankers, on the bulkers side, not so much on the containers or car carriers. When we see the canal start opening up once more to sort of last where we saw it 2 years ago or 18 months ago, we will potentially see a quick unravelling for some sectors of ton miles.
Yeah, exactly, and that's you mentioned is pretty much the container story now. I mean, I don't want to say they won a lottery ticket, because we talk about war after all. But just as we started to observe higher deliveries of that massive order book for the box ships, then, and of course we started to wonder about the oversupply, and then the next thing that happens, they can't go through Suez, so that extra 30 or 40% distance they have to cover around the Cape of Good Hope is the savior, and in fact actually they still do pretty good money. So the question is then, okay, it's very difficult to ask, for how long do you think it's going to stay? It could be another 6 months, could be another 12 months. But arguably, I think we still believe that at some point it will be reopened.
Yeah.
And I think that would be a very sort of a quick wake up for the box
Yes,
guys,
yeah.
in terms of
I mean,
rates.
to try and put some numbers on it, if you compare how many additional vessels are now operating on Asia-Europe, September 2023 to September 2024, it's about 1.4 million TEU worth of vessels that have been added to that trade over the course of the last 12 months. Now, there has been some incremental trade growth, i.e. more boxes are moving, but the majority of that is just for the liners to maintain their schedule, their weekly schedules, calling into Europe. Now, if you look at how many vessels have been delivered over that period, it's almost a like-for-like match. And if you factor in some of the incremental demand on some of the other main haul and non-main lane trades, it helps explain why the market is so tight because those diversions, those extra ton miles have really absorbed that additional tonnage. And now if you look at the container ship fleet, the idle tonnage is less than 1%. We're sort of back to the sort of COVID, the sort of boom era during COVID. So if a liner company does want tonnage to operate on one of its services, it has to pay through the nose for it. And that is sort of explaining why we're seeing rates at the rates that we're seeing today. And also some of the liners that are actually booking vessels that they won't receive for sort of 6 months at today's rates because they don't know how long the disruption is going to last. At MSI, we were hopeful that we'd see a resolution quite quickly to the events in the Red Sea. We're now assuming it will be perhaps in the sort of second half of next year at best. It's difficult currently. Things haven't moved a huge distance over the course of the last 12 months to see some resolution in the Red Sea events. So when it does resolve, will everything go back immediately? I think the liner companies will take some time to reorganize their schedules. The liner companies also have a lot more operational elements in their armaments, so to speak, now versus perhaps they did 5 years ago. We know that the liners will do things like blank sailings. There is a lot of tonnage to be scrapped in the container ship fleet.
And a fleet, as a matter of fact, nobody's scrapping.
Yeah. And we do expect to see perhaps the container ship fleet slow down a little bit more. With impending and ongoing regulations. So I don't think it's all bad news for containers, but the real draw at the minute is those Red Sea diversions, which is sucking in this huge order book that continues to grow, which is sort of still casting a very long and looming shadow over the sector.
Yeah, and it's funny to say, but you said the numbers, how much is now extra delivered from a shipyard is constantly close to how much the trade soaks up. But we have to remember that we keep delivering those vessels, and there's only one Cape of Good Hope, right?
Yes.
So, but certainly, I don't think anyone is unaware of a possibility of at least a short-term oversupply for containers. But it's quite interesting, how they benefited yet again from the current disruption in the Red Sea.
Yeah, no. And the tankers and bulkers the same have also benefited. I think if you look at from our analysis, so our models have been in existence in some shape or form. Of course, they've evolved over the course of the last sort of 40 or so years, but our models have been in existence since the 1970s. So the Suez Canal has been shut before for extended periods, and the models actually capture or were built in and around the time when the Suez Canal was shut in the late 70s and early 80s. So in our models, we're sort of able to sort of shut the canals, we're able to alter the availability of the canals. And, if you look at, even for the LR2 tanker sector, and the LR2 tanker sector has done quite well out of the diversions, as we've seen a lot of products that have gone from the Middle East or India into the European market. We're thinking that the diversion around the Suez Canal is probably adding on around 15% to rates on the LR2 sector currently. Okay. So that sort of puts some sort of numbers, and perhaps even a little bit more for the Capesize market. If you start factoring in diversions that we're seeing there as well.
Yeah, I mean, and they're not affected as much as containers, right?
No,
I mean,
no,
some of them go through.
I mean, the containers
I mean,
is a bit more difficult to try and tease
Yeah.
out what the true impact of the diversion is on earnings.
Yeah.
Just because of the line of service that obviously the container industry runs on, versus the sort of more fragmented world of tanker and bulker shipping.
Yeah, absolutely. Above everything we just said, there's also other inefficiencies in shipping. Where do you see them?
Yeah, well, I think that's a very important point. I think as an industry, we perhaps get hung up a little bit on the ton-mile concept.
Mm-hmm.
And I think the reason we do is because it's a relatively easy variable to wrap your arms around.
Mm-hmm.
How much cargo is moving,
On
how
what
far
distance, yeah.
is it going? I think what we also try and do is at MSI is sort of try and bring in the inefficiencies and the efficiencies of shipping into our modelling, into our calculations of the market. And by that I mean the speed of the vessels, by that I mean port waiting time, load discharge time, ballast ratios, and even when we start in forecasting, we have to factor in things like the evolution and size of vessels to take those in consideration. So then the reason I mention it is because we are seeing potentially, and we have seen a lot more in the way of port disruptions and waiting times. Now the two examples that I always give to just explain how important port waiting times are and how you miss so much if you just look at ton miles. I always used to use the example in 2008, you had a third of the Capesize fleet off Australia waiting to load. It wasn't a ton mile story then, it was the fact that you had a third of the fleet inefficient, doing nothing, sitting doing nothing. That was always my example up until COVID, when we had a very similar situation with container ships off Long Beach, off LA, for kilometres off the west coast of the US. In 2008, Capes were earning over $200,000 a day. As a consequence, in 2001, container ships or Panamax were earning $200,000 a day due to that waiting time and that inefficiencies. And I think if we start talking about some of the environmental impacts, we know that we're seeing changes in weather. That in itself is causing more disruption in and around ports, in and around waiting times. And then geopolitical decisions, we're having to see a lot of vessels, as we did last week with the strikes on the east coast of the US, just sitting, waiting to see if they could go in or not. And no one really knew how long that strike was going to last, but the liner companies decided just to move their vessels outside of port and wait until the ports become available. So I think it's really important to sort of layer on, we call it sort of demand required. So we have our tons of cargoes moved, and then we have demand requirements to move that cargo.
So essentially you adding another dimension, which is time.
Yes.
So you're going to have
Exactly.
ton-mile day.
Yep.
Exactly.
Just
to make those numbers even bigger, right?
Yeah, that's a nice way of putting it, ton-mile day. Yeah.
Something, because that all boils down to how much time actually a vessel is occupied in a way.
Yes, exactly that.
There you have it. Yeah. So as I said, then we had billion tons. Then if it's going to be like trillion ton miles. Then if you add days, it's going to be quite big numbers.
Yes. Yeah.
Well, good. The one more question, simply because I have to ask. The new commodities, they are not all necessarily new, but I'm talking about the niche markets like ammonia, methanol. There's a lot of talk about it due to decarbonization, and of course, ever so growing now demand for those vessels. We know there's quite a lot of them, ammonia capable, for instance. I'm not talking about hydrogen, let's just keep it, for the future at the moment. But where do you see those? Are those trades becoming a more sort of pronounced or visible versus the volume markets, or is it still we talk about the very, very low volumes being transported?
Yeah, I mean, if we're talking about clean methanol, clean ammonia,
the green ones, right?
The green, the blue and the green. There aren't any cargoes currently
Yeah.
on the water. So let's just sort of get that straight. There's nothing that's being moved currently. So anything in the future from a zero is an infinite improvement. We expect to see the first cargoes being moved in volumes in 2026. I think we've been monitoring now the sort of clean hydrogen or the clean ammonia, clean methanol, i.e. the sort of hydrogen economy now for about 3 years. We now have a model in place where we're looking at the development of projects around the world, both blue and green, looking at where we expect to see the exports and the imports of these cargoes. The one thing I would say is that we are seeing a lot of the projects being pushed back. As we're monitoring them, they are being pushed back, so they won't come to fruition, they won't come online as early as we first anticipated. So by 2030, we think there'll be around 15 million tonnes of clean ammonia, 15 million tonnes of clean methanol shipped.
All right.
Which from a standing start is quite good going. As we sort of move out to sort of 2050, if we sort of look at the crystal ball right out there, then you are talking some significant volumes, around 200 million tonnes clean ammonia, around 100 million tonnes of clean methanol. And those are quite large in comparison. So for example, the current ammonia trade of grey ammonia is around 13 to 14 million tonnes. So it is a growth story. I don't think it's going to come as quick as some participants in the industry expect. And by that I mean the orders that we've seen very recently over the last couple of years for either medium size or more numbers, the VLAC, the VLGC/VLAC alternative. And I mean, it makes sense. I mean, the additional capex for a VLAC over a VLGC between 1 and 2 million, depending on where you go. So you're sort of placing a bet, really. Yeah. A lot of those vessels, the majority of the 60 or 70 so VLGCs on the order book or VLACs on the order book won't be trading ammonia in this decade. But perhaps...
Well, you gain flexibility.
Yeah, exactly.
And if you sell it to someone else.
You're buying an option for not much, basically.
Okay. But to call them volume markets, we need to wait until 2050.
Well, yeah, until you're getting into the big numbers.
Yeah. Okay.
But I mean, it's a positive for shipping. It's a new cargo. So I think it's one to watch.
One to watch. Exactly. Well, now into something completely different. One of my favorite subjects, and we've discussed it already, quite a bit. So. We talk about tight markets. We talk about those earnings, sometimes monumental earnings for some of the guys, like the container guys. And shipping's been doing quite well for a number of years right now. You come to think about it. When was the last time we had shipping doing pretty well for 3 years, without any changes? That's quite unprecedented, I would say. But nevertheless, I mean, I want to sort of go into new building markets now, and particularly where do you see new building prices? Because as much as I tell people often is this, we're very good in building stories. And just because a story makes sense, is logical, it doesn't necessarily mean it's going to happen in the future. In fact, usually it doesn't. A lot of people bet on scrapping, but we haven't had any scrapping for a number of years. Now, the question is, because all those stories are very nice, but both of us actually, we remember the stories made in 2006, 2008, right? That was about China, that was about globalization, and then, we were setting up the good growth for another 30 years, and little did we know 2008 kind of changed that trend a little bit. So I would argue that we also are a little bit in a bubble now, at least in terms of ordering, and particularly ordering such high prices. Where do you think, blunt question, do you think they will continue to rise, or are we just about to level off? What's your take on new building prices?
Well, yeah, as you say, it is a hot topic, and it is one that a lot of people are almost betting their house on, really, given the volumes of container containers and gas carriers that have been ordered, and perhaps more recently tankers, car carriers as well. I mean, our view is it can't go on forever at these high levels. Now, the reason I say that, there are many factors that sort of go into to sort of formulating new building prices. If we think about the costs, yard costs have come off quite a bit. Certainly, if you look at something like steel plate prices, 18 months ago, they were touching $1,000 per ton. Now they're close to $600 a ton. We're not in that inflationary pressure that we were sort of 12, 18 months ago. So yard costs have come off. I appreciate that wage inflation in places like China still continue to push up. So that they've not collapsed. They've just come off from the levels that they were 18 months ago. I mean, to believe that new building prices are going to stay high or even go higher, you have to believe that there will be more vessels contracted going forward than there will be delivered.
Correct.
The thing is that, as you've alluded to, we've already seen a lot of vessels being contracted in the container ship sector, car carrier, gas sector. We think that has almost run its course for the container ship sector. I know that there's a number of orders that are still on the drawing board that may come out over the remainder of this year, but it can't go on at the same levels that we've seen in the last 36 months. So container ship orders will come down. When it comes to where the replacement for ordering will come from, you have to look at tankers and bulkers.
Mm-hmm.
Those fleets are now old, I would say, on average. They're sort of mid-teens.
Tankers are very old.
Very old, yes. Yeah. And the problem there is that there's a number of reasons why we don't necessarily think they're going to see huge sways of, say, dry bulk orders in the next 18 months. One is the new building price, which is high, so that has to come down before we see new ordering. Two is that you have to wait a number of years now to potentially get that. You place the order today, you perhaps get it back end of 2027, 2028. Do you want to sort of risk that sort of time lag between ordering and taking delivery? Three is, of course, the uncertainty with new technologies. I've certainly spoken to a large number of dry bulk owners that just don't know where to place their bets. They do see it as a bet in terms of new technologies, new fuels. So they're waiting to see other sectors, other vessel types sort of be the first mover and try and learn in sort of 2 or 3 years, and then sort of start placing orders, perhaps at the end of the decade. So we think that it's a very simple chart to do. You just look at the net order book position. Does the order book go up? Does the order book go down? If the order book goes down, then history tells us that new building prices come down. And we have seen a lot of new shipyard capacity come in to try and help manage take advantage of the profitability at shipyards. If anything, that's going to be a net negative in the medium term for new building prices, because what you'll have is more shipyards competing for fewer orders,
absolutely.
which will potentially pull the price down. We're not saying that the new build price is going to fall, tomorrow, next week, or next month, but I think by the time you're looking at the second half of 2025, we do expect to see some movements in the new building price.
Yeah, completely agree with you here. I don't think they will fall off all of a sudden. I mean, you still have a volume of the ships coming out of and shipyards, and the future cover for shipyards now is well over 3 years, if not 3.5 years. So they sit quite comfortably. It's still a seller's market at this point. But I mean, as you said, the container story is not a never-ending one, and even the gas story will at some point sort of stop, and then you will have more and more capacity available for the ships, and you will drag those prices down, not necessarily to the same level as we said before. As you mentioned, labor costs, that you're not going to do much about it. It's going to be incrementally higher cost for a shipyard to build a vessel anyway. But the steel is on I think it's 30% of the costs. So that's what you can say. But I mean, I absolutely agree with you that we're probably, I mean, we'll argue not we are the highest new building prices now. I think I'm quoting Clarkson's right now. Is in nominal terms we are the highest ever in history, higher than 2008, and they claim the inflation adjusted we are 20% below 2008. But I mean, as I call it, 2008 was setting a level of insanity. So, as I say, if you're comfortable being 20% below insanity, good for you. But anyway, Adam, it's been an absolute pleasure. I mean, time is catching up with us, so we have to stop here. But thank you once again for being with us. Thank you for sharing all your knowledge. It was definitely interesting. And I hope to see you soon in another episode.
And thank you ever so much for the invite.
Well, this was absolutely our pleasure. Thanks.
Cheers.
Thank you for joining our videocast. I hope we managed to shed some light on the underlying drivers behind such strong markets these days. Plenty of disruptions and inefficiencies have led to much increased ship demand, thus driving freight rates upwards. It is a good moment to remind ourselves that we should not only look at tons of cargo, but also at the distance on which it has to be carried. And to build on what Adam mentioned, there are even more dimensions, such as days that ship use, or sometimes waste, at ports, channels, or other bottlenecks. So do not only look at the tons, but also miles and days, if you want to understand the bigger picture of the seaborne trade. And one more thing, I don't know how many times I said it, learn from the history. As we all got comfortable with great paying markets, it is easy to forget that high cycles do not last forever. This may come in handy when we try to predict new building prices. Tight markets will likely rebalance themselves, ultimately putting pressure on prices. Believing in constantly growing fundamentals is risky and has proved to be rather lethal many times. Just recall 2008 and how long it took to recover from that supercycle. Once again, I would like to thank Dr. Adam Kent for joining us today and sharing his views. We hope it has given you some interesting perspective on the current drivers behind the shipping markets. As always, we encourage you to explore all our resources available on our Maritime Impact online platform at dnv.com/mi. Stay tuned for the upcoming episodes of DNV Market Views. Thanks for watching, and we will see you next time.